Hi, I'm here with Chris Heaman. He's a discretionary portfolio manager and he's been working in the industry since 1993. He specializes in volatility investing. Welcome, Chris.
Thanks, Lisa. Thanks for having me back.
Okay, let's talk today about the macroeconomic investment model. So tell us, what is the macroeconomic investment model?
Well, that's a great question. We touched on it last week. The last time we talked, we kind of give a quick little overview of using a guideline, a map, to help us build and construct portfolios. And so what we use is this macroeconomic model that allows us to look at what's happening in the economy and what things that are going on can help us make really good choices in our investments and places to stay away from. So this is for very long-term investing. It's not for trading. It's a longer-term investment model, but it helps work through different areas that you can put into your portfolio that will benefit you depending on what economic environment we're in. So let me pull it up. We'll start there with our graph that shows what it looks like. Here we go. So think of it like a roadmap. You want to go from point A to point B, and it kind of helps you determine how to achieve and where to go on your journey. So it's a great place to start. When you look at the investment world and the universe, you have so many different investments to choose from. And how do things work? We talked a little bit about correlation the last time we talked. How do things work together, like that recipe or like baking a cake? So a really good way of looking at this is the recipe card for making, we'll call it baking a cake. Okay. So if we follow the recipe card exactly the way it's laid out, then we'll have success. If we just throw some baking soda and some eggs together in a bowl and we whip it up and throw it in the oven and we hope that the cake turns out, we probably won't have much success. So what a macroeconomic model helps us with is which pieces, which ingredients do we need depending on where we are. So today what I thought I would talk about is how do we determine in which box are we? Okay, so in my little view here, we've got these color-coded areas. Right now, we are in this stagflationary orange box on the bottom right-hand corner. And on the axis here in the middle, it talks about economic growth at the top and inflation. So as economic growth is actually increasing when we're growing in the economy, and while we're doing inflation is rising, from on this axis, from low to high, if we have a high inflationary environment, then this particular area to be invested in works very well. Okay. And it allows us to stay away from some things that won't work very well in these conditions. Now, when these conditions change, when you get economic growth increasing, but you have decreasing inflation, for example, then you get in the top left-hand corner, which is called, well, we call it a deflationary boom, but it's different investments react differently to the environment they're in. Does that make sense so far?
Yeah, absolutely. Can you give us an example of some of those sectors or some of those ideas of where we could put our money in those kind of different time periods and the
Absolutely.
different.
So when we're dealing with growth and inflation, we got to look at some of the indicators that can help us with that. How do we determine growth and how do we determine if inflation is going up and down? But down here in the bottom, it kind of gives us a list of some of the ideas. And certain investments like utilities and real estate through REITs are really great investments when you're dealing with a rising inflationary market. Okay. Bonds, fixed income, not so much. Um, However, there is a type of fixed income investment called an inflation protected credit. So in Canada, it's called real return bonds. In the States, it's called Treasury Inflation Protected Securities, or TIPS for short. So what it is it's fixed income investing that has a certain amount of interest that pays you, but then pays you whatever inflation is on top of that. So it gives you a little bit of protection against that erosion of purchasing power, which is what inflation really is. It's the loss of purchasing power of your money. And so gold and precious metals like silver and palladium, things like that are a good place, a little defensive, um, as well as utilities. If you consider that utilities are the ability companies can pass on higher expenses to the end user, and most people don't stop paying their utilities bill. When things are under crisis and you've lost your job, you might stop paying your credit card. You might take a few months off paying your car loan, and you might even put your mortgage on deferral, like we've done. We'll talk about here in a bit. But utilities, they tend to be something that you always pay.
Awesome. That's great. So you think right now we're in the stagflation area of this economic growth model. Do you see that changing? What do you see happening in the short term and maybe even long term?
Well, in the short term, we can, it doesn't really change quickly. It takes a while to work through. And so I believe we've been entering it for the past 3 months. What's happened in this recent crisis is that we've got a lot of government support. So although economically, the model is showing, wow, we've got a lot of high unemployment, we've got GDP growth, which is a way to measure growth, which I'll have some information here. We've got these things happening, but at the same time, we had this incredible amount of government support, which really just filled the gap in what was happening in the economy. So remember that our economy is consumer driven, which means over 75% of what happens in our economy for growth comes from us as consumers, us buying, us interacting, us being out there at restaurants, going shopping, buying for birthdays and Christmases, all of those things, new cars, new homes. That's the consumer side of the economy. And that's been really impaired and impacted. But the governments, both Canada and US and around the world, they did a lot of things to help support consumers. And so we've had this huge increase of liquidity in the market because people have been paid to stay at home and be isolated. And then we've had this huge amount of what they call stimulus. It really isn't, but it's support is the better word. It's to support people who have lost their jobs due to the COVID, or their income has been reduced, and it's to help them get through. Okay. So a couple of the key things that happened is that the government allowed people to forbear or defer their mortgage payments or their rent without any impact, and that's just starting to taper off. They allowed people to stop paying their car loans for a few months, and banks were very supportive, making sure that if you couldn't afford your debt, we would help you out. Now we went through the biggest part of the crisis, and now we're starting to get to the end where these programs are starting to taper off. And so we still feel that economically we're not back to where we were. We're going to take a while to grow back to where we were, but we're starting to see the run out of this government support.
Right. And that's going to cause a lot of unraveling over the next year or so.
Well, it could take up to three. I mean, I don't know how long it would take, but it's not going to take months. And now we've seen some short-term positives. So let me just shift gears here a bit with my chart, and let me show you this one here. Okay, so I'm going to start in the US first. This is the annual growth rate of the GDP of the US. Okay, so all GDP is a mathematical way to express how much did our country make, produce, and earn. Essentially, it's an economic way of measuring the economy, so that we have a number that we can use to kind of track how we're doing. And as you see, way back in the last time we had a big crisis called the Great Financial Crisis in 08, 09, we had negative GDP growth, and then we rebounded. Okay. So it doesn't take 2 weeks to do this. It took 18 months. Okay. Now, we don't have the Great Depression on here, but if we look at economic GDP shrink, how it shrunk, this time, way down here on the right-hand side, we're much steeper than it was here. Okay. Now, I'm not sure it's going to take the same amount of time. It could take longer, but it probably will take at least the same amount of time. Okay. To get out from underneath all of this economic damage. When we look at the Canadian, it's a very similar picture. Okay. So here's our Canadian GDP growth. Okay. Same thing happened back here. But you can't see it now because I've taken away the US. But back in 2001, 1999, 2001, although we slid, we didn't really go negative in Canada. Okay. And then it took a while. We go up and down, up and down. We have positive growth and negative, positive growth that is less. So we've grown less than we did in the past. But it's only been since 2008, 2009, since we had negative GDP growth, okay, when our economy actually shrunk. And that's quite concerning. That's one of the things we use to measure on our macroeconomic model, our growth metric. Okay, so are we growing or are we shrinking? That changes measured month to month, quarter to quarter. So every month in Canada, we can measure it, and every month in the US, we can measure it. Okay, and so things don't change rapidly in the economy, but the stock market can not reflect all these things for quite some time, and then all of a sudden reflect what's underneath the surface. Does that make sense?
Absolutely. And right now it feels like, and you can maybe touch on this more, but it feels like with these numbers, like if you look at the GDP growth, these last two charts you've just shown us with such dramatic negative numbers, it is completely a dissonance compared to what's happening with the stock market. Like it's completely not jiving that way. It doesn't make
That
any sense why the market is still so high.
Well, it makes a lot of sense if you understand that the market is not the economy. The market is millions of people making a bet or a gamble on where the economy or where businesses might be. So, stock markets can be like a casino in the short term, okay? But in the long term, they're more like the economy. They track a little bit more. So in the short term, we can get craziness, okay? A lot of the things that happens in the stock market have a lot to do with human behavior versus economic conditions. And so if we don't have that information, if we don't know about the information, then a lot of times the stock market can be what they say leading. They think that it's going to be figuring this stuff out. And a lot of times for me, being in this industry such a long time, it's basically a bunch of people getting really excited and really depressed. So last time we talked, I went over some of that, the curve of how human emotion can be impacted by all of this information. Right back in March, we got panic, and then the government started to give us all this money, and we are all like, have hope again. What happens is that as things play out over the longer term, things start to come in line. But you can get euphoria and you can get craziness in the stock market. We've seen that in things like Amazon or Shopify, where everybody thinks that we're all going to be in our homes forever and we're all going to be ordering our groceries on Amazon. And so people buy Amazon thinking that, well, they're just going to continue to make money. Okay. Same thing with, airlines and cruise lines and places like that and hotels. Everybody gets fearful, but nobody's going to go there again. And so they sell them all off. And then as information starts to creep back in, people start to make different decisions. Okay. So one of the things that we'll move here, just to give you another image to look at that helps with growth, is to look at the unemployment numbers and how things are playing out in the unemployment. Just bear with me here as I get the graph up for you. I need that one. There we go. No, that didn't work. I think it's this. This should work. There we go. Technical difficulties. Okay. So this is the Canadian unemployment. Again, numbers that come out on a monthly basis. Okay. So our unemployment numbers were quite high, right? Going after the COVID crisis in March. So when you go through April and May, you get this huge increase in unemployment. Okay. And then the government produced things like the CERB and the Canadian Employment Wage Subsidy Program. It's very similar to things that did in the US. They tried as hard as they could to make sure that people who got impacted by this were no fault of themselves, and this was a massive issue in the economy, that were supported. And now we're starting to see the unemployment numbers come off. However, that's a good thing. If you look back, our unemployment numbers going into this with a robust economy was about 50% of what it's at right now. So it's twice as big, even after we've started to get some sort of recovery going on. So we got to watch sometimes that we don't get caught up, because the math can be very confusing and tricky. And when you say that, well, we had this huge decrease in GDP, they annualize it, and it was like negative 30% on an annualized basis, you're going to get a GDP number coming forward that's going to say it's positive 30% off the bottom. Now, those two 30% don't cancel out, just like unemployment numbers spiking and then dropping 50% doesn't cancel out. Okay. So, depending on how you look at it, you could hear a lot of positive news in the media, and you could say things are getting so much better and we're on the road to recovery. Well, we're still pretty far away from recovery, but things have improved. Okay. So
Yeah.
that's one of the reasons why we measure these things on a monthly basis or a weekly basis. In the States, we actually measure them weekly.
So in other words, you don't make your investment decisions based on headlines on CNN.
That is, yeah, that's I'll let you say, yeah, don't make your investment decisions based on headline news. Like,
Yeah.
there's a lot of information that doesn't get produced today. It's produced and it's put out there, but it's not mainstream. It's not headline. Okay. One of the big factors in the US is that their numbers, if you take just a piece of it, look fantastic. But there's a lot of other pieces of information. So in their unemployment, they run a weekly basis, but they also run one, which I'll show you here, is called continuing claims. Okay. Now, there's a difference between applying for unemployment for the first time. That's an initial claim. Then, if you don't ever go back to work, you're still collecting. It's called a continuing claim. Okay. So, as we see in this graph, this is the US version. We had that spike, and then we've been slowly going down. And then we're starting to taper off. We actually, week over week, increased again, continuing claims. Now, when our crisis first hit, a lot of our service in jobs were impacted: restaurants, waiters, bartenders, contractors, right? People like yourself and I, we can still work from home, right? So we weren't quite as impacted. Okay. But as this continues and as jobs aren't coming back, we're starting to see temporary layoffs turn into permanent. So one of the headline news that's out there is about the big airline companies in the US that are about to, they furloughed 20,000 people, which meant at the very beginning, they put them that they were temporary, but now in October, they're going to make them permanent, and we're losing thousands of jobs. Okay. There was just another headline news that hit in Toronto that there was, I can't remember the tech company is laying off 10,000 people. They have like 54,000 square feet of office space. Okay. So there's still a lot of this that has to be worked through. It takes a while to let the economy actually heal itself. And when you get government intervention, it's kind of like being in the story I always give is it's kind of like that war movie where you see the guys, they're in the foxhole and they're all shot up and they're not going to make it, but they put them full of morphine just to make the pain go away. Okay. It's kind of how our economy is right now. We've given ourselves a lot of support, but we haven't really fixed the underlying problem yet. And we have to let the economy heal. That takes time. So there's a lot of places that we still have some issues and we want to pay attention to.
And Chris, this is why I think it's so important to work with a professional portfolio manager such as yourself, because anyone who has any logic and looking at the macroeconomic environment right now, the things that you shared with us today, unemployment, GDP, all those numbers looking very gloomy, you all but want to run and put your money under a mattress. So there are still areas in this environment where we can still make money. And I think that's why it's so important that people see this and they understand working with someone like yourself is so important. So thank you so much for this. Is there anything else you want to add?
Well, I just wanted to finish up that tying this all back in to why the macro model, you start there first. Okay. It just helps you create that recipe, that oversight of where are good places to be? I mean, what I've got up here is the idea of what's diversification or asset allocation. It's making sure you have your money in different places, cash, bonds, property, equities. This is just an illustration, right? But you can also own commodities. So, one of the number one places that benefit when inflation is going up, it's costing more, is commodities. And that means that if you own things like gold, right, or silver, but if you own things like um, cattle, right, and cows, lean hogs, lumber, these things are starting to go up, and not everybody owns those in their portfolios. Now, it's not easy to get access to. There, you got to really understand how to get access to it. But those are the things that are protective when inflation starts to rise. So the reason that we have diversification is that we have different things that are acting in different ways depending on the environment we're in. A little piece of your portfolio that's placed out to commodities can be very beneficial to own when inflation is going up. Okay. If you've been grocery shopping lately, Lisa, have you seen that your dairy, your milk, your butter, these are all things, eggs are going up like crazy. Okay.
Oh, yes. Yes.
Right. So it's costing us, the consumer, more and more because we are in inflationary, from a consumer point of view, an inflationary environment. Okay. Now the governments like to measure inflation in all sorts of different ways, and economists like to be academic and say inflation really doesn't show up until M2 velocity starts to speed up. And all of that doesn't affect your pocketbook. What affects your pocketbook is going to the grocery store and paying 15% more for lean protein meats like chicken, meat, poultry, or fish, things like that. And you're trying to feed your family. Okay. And at the same time, you've just lost your job. Okay. Those are the things that affect an economy at the roots. And those are the things that will over time have a negative impact on certain places. Okay. So trying to identify places in that stagflation, that utilities and real estate, commodities, gold and silver, things like that, that are very defensive, very good things to own, and that you'll continue to be paid a dividend from or will continue to grow for you, are places that you can invest some of your money.
Awesome. That's great. Thank you so much for sharing with us today. That's very helpful.
No problem. I look forward to next time we talk.
Yeah, sounds great. Have a good day.
You too.